This is chapter 9 of your textbook, and for Finance 301 students, chapter 9 of your Finance 300 textbook. We're going to basically talk about how to evaluate an investment project in this chapter. We're going to determine what are the relevant numbers to determine the cash flows for the project. And once we have those numbers, we can calculate the cash flow from the project and make a decision using some of the investment criteria we developed in the previous chapter. Now, what's important is we're going to include cash flows that are relevant. What we mean by that is these are the cash flows that would happen only if the project is accepted. And we will also look at the so-called incremental cash flows. In a sense, we're going to look at the difference between the cash flows of the firm if the project is accepted versus if it's not accepted. That way, this is the so-called standalone principle. We can analyze the project in isolation from the firm. Now, what are some relevant cash flows? The so-called sunk costs are not relevant. For example, before you started thinking about whether or not you're going to accept a project, you did a marketing research and you paid a firm to do that marketing research for you to determine if you came up with a new product, what sort of demand would be out there. Now, whether or not you go ahead with the project, you already paid this cost, so it is sunk. So it doesn't make any difference. That way, it doesn't affect your decision. The so-called opportunity costs are relevant. The greatest example is you own a piece of land. Right now, there is nothing on it. If you wanted to sell it, you could sell it for $1 million. But for the project, you need a piece of land, and you wanted to use your own land. Technically speaking, it doesn't cost you anything. It's your own land. You already owned it. You already own it. But you could have done something with that land. It's comparing it to the second best use. If you don't accept the project, you could actually sell that land for $1 million. That means that is your opportunity cost. So that is relevant. The so-called side effects. Let's give an example. Let's think about the company Gillette, the producer of razor blades. Right now they have 5 blades in one razor. Let's say they wanted to come up with a product that had 7 blades. Now, if they come up with this product, some of the people who are currently using the 5 blades are going to switch to the 7 blades. Yes, you may be able to make, let's say, $100 million of sales of the new product, but that also comes with the cost of not having as much sales on the existing products. So this is, in a sense, a cannibalism or erosion of your existing products. This is a real effect. You cannot simply take $100 million as revenue from the new product. If you're losing $50 million of the existing product, then the net effect is actually $50 million. It is rare, but sometimes there are positive side effects. If you launch a product that will have a positive influence on the sales of your existing products. In general, I would take such claims with some doubt, but that would also be an example of a side effect. Whenever you come up with a new product, in order to support the sales, sometimes you have to add to your net working capital. These could be in the form of inventory or accounts receivable, because you're going to do some of the sales on credit. And if it also comes with some accounts payable, that's fine too. Any change in net working capital is a relevant cost. If to start this project you had to add $10 million to your net working capital, that's going to be part of your initial cost. And during the life of the project, any increases or decreases will also have to be accounted for. If on year 5 you no longer need $10 million, but you're down to 8, then that $2 million extra should be considered as a cash inflow to the firm. In a sense, when the project starts, the project borrows $10 million from the firm as net working capital, and when it goes down to 8, it returns 2. So that is a cash inflow for the firm. When the project ends, all the net working capital is returned back to the firm as a cash inflow. Next, let's talk about the tax effects first. Tax effects obviously are relevant. Oddly enough, financing costs are not. You may view this as kind of odd. You know, if I'm paying 5% interest on cost of financing this project, why is it not relevant? That comes from 2 reasons. One, the so-called standalone principle. The project doesn't know how it is being financed, or should not know how it is being financed. It shouldn't depend upon whether you accept the project or not, based on whether its firm is debt financing or equity financing. And second reason is financing costs are implicitly built into the discount rate. In that sense, they are being used, but not as part of the cash flow. In our next video, we're going to talk about how to calculate pro forma financial statements, and using the relevant cash flow concept, we are going to figure out operating cash flow, which is earnings before interest and taxes, plus depreciation minus taxes. And since we're not using any financing costs as relevant, operating cash flow is effectively net income plus depreciation. Once we have that, we can calculate cash flow from assets, which is operating cash flow minus net capital spending minus change in net working capital. We're going to go into details of these on our next video.